This is Ethan, CFA Charterholder and investment professional, and today I'm going to compare BALI versus PAPI. Wait, sorry, the other BALI and PAPI on 5 key metrics for covered call ETFs: income amount, tax efficiency, income consistency, long-term growth potential, and downside protection. Let's dive in. Both of these are actively managed ETFs that may seem similar on the surface, but actually take very different approaches toward achieving a similar objective. At the heart of it, they both invest in dividend-paying companies and supplement the income by selling covered calls on the S&P 500. If you already know what a covered call is, you can skip ahead about 45 seconds to the next chapter. But for those who need a refresher, we'll start with that. What's a covered call ETF? In a nutshell, it buys stocks, then writes, or sells, that's the same thing, call options on them. A call option gives the buyer of the option the right to buy a stock at a set price. Of course, they'd only want to do that if the stock went higher than that price. So if you're selling those options, like these ETFs are, that means someone else gets to benefit from the upside in the stocks if they go up a lot. So to recap, these ETFs buy stocks, then sell call options on them. That means you get a little of the upside potential, but then anything beyond that set price, which is called the strike price, you give up. And what you get for giving up your upside potential? A juiced up yield. And since that's the main reason people buy ETFs like BALI and PAPI, let's start with how their differing approaches will impact their payouts over time. Over the last year, BALI has paid out 6.45% yield, where PAPI has paid out 7.11%. Pretty similar. But the way they get there is completely different, and that has implications for which one is likely to be the higher yielder in the long run. So, is PAPI always likely to have the highest yield? Yes, probably, but not for the reason you might think. Here's where we'll start to get into how the strategies are different. For the yield level, there are 2 factors to consider here. The first one actually leads me to believe that these yields might get closer over time, but the second one is more important in my opinion, and it's not reflected in these numbers. BALI is actively managed, but actually buys stocks that are pretty similar to the S&P 500. Here's a quick comparison of BALI's top holdings on the left and an S&P 500 ETF's top holdings on the right. Not identical, but very close. So BALI isn't really just loading up on dividend-paying stocks. Instead, what it's doing is using a dividend rotation strategy. Basically, that means that it's moving money around to buy companies right before they pay a dividend, then selling out and buying a different company that's about to pay a dividend. As you probably know, most companies pay dividends quarterly, or sometimes less, and you only have to own it a couple days before it pays out to collect the dividend. As an individual or in a mutual fund, this would be an incredibly stupid strategy because it would lead to a significant amount of short term capital gains and make the investment extremely tax inefficient. However, since this is in the ETF structure, they can probably mostly or entirely avoid that issue. Then, on top of the portfolio, they write call options on only a small percentage of the portfolio. I'll dive more into how much and the other aspects of the strategy in the sections where they're more relevant, but for the income level, this is what's important. Hoppy, on the other hand, buys parametric dividend income, which is another mutual fund that they manage that has a 10-year track record and has a very different portfolio. You can see from the holdings list that the companies it holds are first really different. Then you can see from the highlighted holdings percentages that it is also way less concentrated. And then you can see from the blue dots in the style boxes that PAPI consists of a much smaller, more value-oriented portfolio of companies than BALI. Going back to our comparison of the underlying holdings, using parametric dividend income for PAPI and an S&P 500 ETF for BALI, dating back to parametric's inception, you'll notice 2 things. First, PAPI's underlying holdings have historically had a much higher yield. That's no surprise. But second, focusing on the right 2 sets of bars, PAPI's underlying holdings now have a higher yield than their long-run average, and S&P 500s have a lower yield. That's mainly because the S&P 500 has become so much more concentrated in large tech-oriented companies that don't pay dividends, and the valuations of large caps are near a historical high relative to small caps. Well, companies don't actually pay out a percentage, right? They pay out a dollar amount, like 50 cents per share. And the higher your share price is, the lower your yield will be for the same payout. A 50-cent dividend for a $10 stock is a 5% yield. If the stock price goes up to $20 per share, that same 50-cent dividend is now only a 2.5% yield. So Since large caps are more expensive relative to small caps than usual, their yields are also likely lower relative to small caps than usual. So, all else equal, if we go back to a more normal environment, that could boost Bali's yield relative to Poppy's, since Bali is investing in a lot more expensive large cap companies. However, there's a bigger factor at play in favor of Poppy, which brings us to the tax section. After we cover this, I'll declare winners for both income level and tax efficiency. On the bottom here, you can see that Poppy is managed for tax efficiency and Bali, well, isn't. My impression of Parametric as a company has always been that they are obsessed with tax efficiency, and it's a big part of what they're doing in this strategy, too. They do it in 5 ways, each of which addresses a weakness in other high income strategies. Starting on the left, they emphasize distribution yield. Basically, here, they're saying that the SEC yield is worthless, which I agree with, and there may be more tax efficient ways to generate income than just through stock dividends and bond interest. Most covered call ETFs use these, but when compared to something like a high yield bond fund, where almost all of the returns are taxed at your maximum income tax level, it's definitely more tax efficient than those. From here, it gets more interesting. On the upper left, they maintain a qualified dividend classification. This is important because most stock dividends are qualified, meaning they're either taxed at 0 or 15% for most people, and capped at 20% even if you're in the highest tax bracket, which for this purpose doesn't start until 500 something thousand dollars per year of earnings. However, there are things that you can do that will lose you that qualified status and force you to pay your income tax rate on your dividends. For a lot of people, that could be more than double the tax rate. Two of those things you can do that would lose your qualified status and make you pay a higher income tax rate on your dividends is one, not holding a company long enough, which Bali may or may not do with their dividend rotation strategy, and what's called a tax straddle with an options writing strategy. Put simply, it's a way to evade taxes, and the IRS doesn't allow it. I don't know if Bali is guilty of either of these things, but I do know that only 42% of Bali's dividends in 2023 were qualified, which means the rest were not qualified and taxed at a higher rate. Sorry, it's a little small, but you can zoom in or look this up on Bali's website yourself. Moving to the upper right, you can see that they also use tax loss harvesting like SPYI and QQQI, which we've covered in previous videos. Essentially, that means they marry up something at a loss with something at a gain as they're selling, which allows them to classify some of their income distributions as return of capital. That's the next method over on the right. When they do that, the portion of income you receive as return of capital is not taxable in that year. Now, don't get me wrong, you will have to pay taxes on all of your gains eventually, but this process can allow long term investors to defer some of the taxes until later and potentially pay the lower long term capital gains rate on a higher percentage of their overall gains. As a reminder, gains on investments that are held for more than 1 year generally receive that lower long term capital gains rate. Bali will have some of their income as return of capital too, but they're not really doing any tax loss harvesting to maximize that. In the ETF structure, I'm not sure how much that'll matter, but all else equal, it's a point for Poppy. And that brings us to my favorite one, selling options directly instead of using ELNs. This is basically a direct shot at JP Morgan's ETFs like JEPI and JEPQ, which I just simply find hilarious, but Bali doesn't use them either, so I won't spend any more time on them here. When you put it all together, Poppy is clearly the winner on tax efficiency since they're the only ones actually trying to be tax efficient, and that's kind of Parametric specialty. But that also makes Poppy the winner on income level after taxes. Remember, before taxes, Poppy's is currently a little higher, but I think they might come together over time if large cap valuations come back to earth. So from that, I think it's too close to call. But when it comes to what you're able to take home, I think Poppy's tax efficiency also gives it the edge in after tax yield. Next, let's look at income consistency. Unlike some of the funds I've covered in the past for NEOS and Goldman Sachs, neither of these aims for income consistency. They both say they do in their marketing material, but I think what they mean is paying you every month, not paying you the same amount every month. And if we look at a chart of their monthly dividends over the past year, which is about as far back as we can go given their short track records, neither of them looks very consistent to me, and neither one looks any more consistent than the other. I don't think either of these strategies is particularly conducive to creating consistent income either, so I'll call this one tie. When it comes to long term growth potential, here's an area where I think there could be really differentiated. Even if that's not why you're investing in these, it's important to think about because it determines the long term sustainability of your income. So your income is, say, 7%. Well, 7% of what? The NAV. And if the NAV is declining over time, your income will be too, even if it stays consistent at the same percentage. Sadly, we can't buy groceries with percentages. So we need a strategy that can grow over time to create a growing income stream that would keep pace with inflation. This is assuming you're taking out all of the income, by the way. Obviously, both of these can create growing, sustainable income streams if you're reinvesting the dividends, but I just know most people, unfortunately, don't want to do that. Starting at the bottom, Hoppy builds a more diversified portfolio of less risky holdings and sells calls on the whole portfolio. They sell them a little further out of the money than a lot of the other covered call ETFs I've reviewed, allowing around 1 to 3% appreciation every 2 weeks instead of every month, but they're still severely capping their upside. BALI, on the other hand, only sells options on a small percentage of the portfolio, and then they buy futures to basically make up for the upside that you'd lose from the covered calls. Here's what it looks like. A pure equity portfolio would just be the black bar on the left. But then when you sell call options, you give up some of the upside. The futures give you that upside back, bringing you back to full appreciation potential of an equity portfolio, but still with enhanced yield from the call options. When I exported BALI and PAPI's holdings, here's what it showed. These are both as of November 1st, 2024. On the top, in orange, you can see that the notional value, that's the value of the underlying investment that's covered by options, for PAPI was only about $13.7 million. That compares to a portfolio value of around $161 million. However, they also had that offset with a futures contract for about $12.7 million of S&P 500 exposure. So they more or less canceled each other out, the options that they sold and the futures that they bought. On the bottom, Parametric wasn't so nice to calculate the notional value for me, so I had to do it manually. But in the first box there, you can see that they had a total of 1,642 options contracts, with each option contract covering 100 shares of SPY, and SPY's current price being at $571.15 per share. Multiply those together, and you get a notional value of $94 million, compared to fund assets of $90 million. Why don't these numbers match? Well, they're selling these about every 2 weeks, not every day, and their portfolio isn't exactly the same as the S&P 500. Plus, they're getting inflows and outflows every day, so that'll change their asset numbers. So these numbers are never going to match up exactly. But for all intents and purposes, it seems like they're trying to cover 100% of the portfolio with options. Then, in the box on the bottom right, you can see the strike price of the 3 options that they hold along with SPYI's price 2 weeks before that, since they say they sell options with 2 weeks to expiry. That calculation would show them selling options roughly 1 to 3% out of the money. This is a single point in time, so it's definitely possible that that could change over time, but it's how I came up with my estimates of roughly 1 to 3% out of the money on essentially the entire portfolio. When you take all this together, I don't see how you could possibly not give the edge on long-term upside potential and thus long-term income sustainability the BALI. It has more volatile underlying holdings, meaning probably also more upside potential, and basically eliminates the capped upside from the covered calls, whereas PAPI has less volatile holdings with potentially less upside potential and caps its upside. Unlike pretty much every other covered call ETF I've ever looked at, I actually do think that BALI has a good chance to be able to create a sustainable, growing income stream over time. It won't be stable, but I'd be very surprised if it wasn't higher 10 years from now than it is today. PAPI, I'm not as confident in that one. Jury's still out. Then, when it comes to downside protection, I think it's equally obvious which one the winner is. PAPI has a lower volatility, less concentrated portfolio, and doesn't use futures to retain full market exposure. Remember I said it wasn't a free lunch? Here's where we get to that. Those futures are a double-edged sword. In the long run, you're not capping your upside potential, so it gives you more upside and long-run income sustainability. However, it also basically adds leverage to the portfolio and enhances the downside risk. As of November 2024, BALI has about $161 million of assets, and their covered calls cover about $14 million of notional value. So roughly 8.5% of their portfolio. You lose the upside on that part, but not the downside. You still have 100% of the downside. But then when you add the futures position on, which is basically an agreement to buy a set amount of an investment at a set future date and a set future price, you get the gains and losses from that position. So you basically have 100% of the index's upside potential, but 108.5% of the index's downside potential. Some of that downside would be offset by the dividends, but as far as day to day, week to week volatility and potential losses in a stock market downturn, this strategy enhances them. PAPI takes a very different approach. Not only does it not use futures to add in more upside, but it also builds a diversified portfolio of companies that are screened for high yield and low risk. More specifically, they basically equal weight each sector, then screen companies for income and risk. Within each sector, the companies with the best combination of high yield and low risk are equal weighted. So you basically have a very well balanced subset of companies where low risk is one of the criteria they're chosen on. I don't think anyone would call BALI's portfolio of concentrated positions in Mag 7 companies low risk. So for downside protection, Hoppy is the clear winner. And since I know all of you want to see it, here's how they've done against each other since inception. For the record, I did not even look at this until now. All of this analysis was just based on diving in and understanding how each ETF is managed. One-year track records are not predictive of future results. So if you want to understand how something is going to act in the future, you really need to understand what they're doing and how that might act in different market environments, which is what I'm trying to bring to you here on this channel. But I'm glad to see the results so far have at least aligned with my expectations. BALI in red has absolutely crushed PAPI, but it's also been way more volatile. 2 points for me. With dividends reinvested, BALI has even come close to matching SPY in a raging bull market, which is certainly not common for a covered call ETF. If you found this video helpful, hit the like button, leave a comment with what you'd like us to cover next, and subscribe so you won't miss it. And if you want to connect with my partner Kyla and I directly, you can join our Discord through the link in the description below. We'll look forward to seeing you in the next video.